The price is lying and the spread is telling the truth, because silver already printed a $1,000 spike, just not where most people were looking, and the people who want this move dismissed are counting on you watching the wrong screen. Spot can look tame for a moment, or it can look euphoric, but the stress always leaks out somewhere else first. And right now, it is leaking out through the parts of the market that actually decide whether metal shows up when someone demands delivery. Stay with me, because by the end, you're going to have a clean concrete checklist for the next 1 to 2 weeks. What levels matter? What confirms the squeeze versus retest path? And the one metric that tells you whether this is a real supply chain veto or just another paper tantrum. And here's the first uncomfortable truth. A silver move that looks small in dollars per ounce can be a violent margin triggering punch to anyone carrying real size, because the leverage isn't a rumor, it's the contract math, and that's where the real pressure starts. On a standard silver futures contract, you're dealing in thousands of ounces, which means a move that barely registers emotionally, 20 cents per ounce, can translate into roughly $1,000 per contract. That's your $1,000 spike. Not a headline price of $1,000 per ounce, but a $1,000 hit that shows up instantly in risk systems and margin requirements. Enforced hedging and the kind of, I don't care what I believe, I have to cut this behavior that creates air pockets and then snapback rallies. And that's not a theory, that's basic arithmetic, which is why the most dangerous silver moves often start as nothing to the retail eye and end as everything to the institutional balance sheet. But that's not the part that matters most. The part that matters is what the math forces participants to do when liquidity thins. And the calendar turns. Because silver isn't just traded, it's managed. And management becomes mechanical under stress. If you've been watching the tape recently, you've seen a market that can rip hard and whip even harder. It's been the kind of month where silver can run up into the high double digits, flirt with round numbers, and then shake you out with sudden downdrafts that feel personal. That's not an accident. Even when the bigger trend is up, the path is designed by structure, by positioning, by hedging flows to punish impatience. And if you only look at spot, you'll think this is just another emotional commodity story. Inflation, geopolitics, dollar down, risk on, whatever the narrative of the day is. But silver doesn't move on narratives alone. It moves on plumbing. It moves on inventory classification. It moves on spreads, roll costs, availability, and who is forced to do what at what time. Because if this one level breaks, the math changes. So let OS talk about the hidden detail that reframes the whole setup without sliding into fantasy. Silver has a curve, not just a price, and that curve is where the market confesses what it really fears. In a normal carry market for metals, you often see later months priced above nearby months, because there is a cost to hold and finance metal: storage, insurance, the time value of money. That's contango. It's the market saying, I'm not desperate for it right now. Backwardation is the opposite. It's the market saying, I want it now and I'll pay up for immediacy. In precious metals, deep, persistent backwardation is not supposed to be casual. When it shows up, it's a flare. It doesn't automatically mean apocalypse, but it does mean someone is bidding the front end, and that front end tension is how paper markets get dragged toward physical reality. And that's where the real argument begins, because the silver is manipulated crowd and the silver is just another trade crowd both miss the same thing. You don't need a grand villain to create distortions. You just need incentives positioning and the fact that deliverable metal is not the same thing as metal that merely exists somewhere on a spreadsheet. Here, Star is the inventory trap in plain language. There are categories of inventory that can technically be in the system, but not actually for sale. In many warehouse reporting frameworks, you'll see distinctions like metal that is eligible versus metal that is registered. Eligible can mean it meets the specs and is sitting in a recognized vault. Registered is the category that's actually available to be delivered against futures obligations, typically tied to warrants and deliverability status. That distinction matters because headlines love to say inventories are big, while the market trades like deliverable is tight. And if deliverable gets tight at the same time the front month gets bid, the curve starts to scream, and that scream forces behavior. Shorts who assumed they could roll forever have to decide whether to pay up to roll, find metal, or cover. Longs who thought they'd quietly stand for delivery suddenly realize that we were holding a hot poker that can change the whole negotiation. And the next detail is what flips the whole setup. You don't need inventories to go to zero for this to matter. You just need the marginal ounce to be hard to source at the exact moment the calendar concentrates demand. That's why inventory is not a comfort word. It's a leverage word. Now fold that into the second layer. Silver is a global market with a split personality, OTC settlement layers, exchange-traded futures layers, physical bar and coin layers, Industrial procurement layers. People will point at a vault total in one region and declare plenty without asking the only question that matters. Is it available, unencumbered, and economically movable to the place and form that settles obligations? Metal can be pledged, leased, tied up in ETFs, allocated to industrial supply chains, held as strategic stock, or simply owned by someone who doesn't care about today's price. So a big number on a report can coexist with tightness in the parts of the market that set the marginal price. And that marginal price is what moves first. That's why the spread tells the truth before spot does. You can see it in front-month strength, in roll costs, in the way certain nearby contracts refuse to trade cheap relative to later months. You can see it when liquidity thins and the market stops offering size without moving price. You can see it in how quickly dips get bought, not by hype, but by necessity. And that's where the real pressure starts. Layer 3. Supply doesn't respond the way people think it does, especially in silver. Silver is not just a primary mined metal story. A meaningful chunk of silver supply comes as a byproduct of mining other metals. That means you can't simply jack up silver production on command because silver price spiked. If copper, lead, zinc production is constrained, silver supply can be constrained too, even if silver screams higher. Add refining and logistics, lead times, concentrates to refined metal to fabricated products, and suddenly you are dealing with a supply chain that has inertia. Recycling helps, but it's not a magic lever. If the market gets tight at the front, you can't solve it with a tweet. And that matters this week because tightness doesn't need to be permanent to create a violent move. It only needs to coincide with the periods when obligations concentrate. Delivery windows, option expiries, month-end balance sheet decisions, quarter-end risk limits. Now that's the why now trigger, and it's not mystical. It's calendar math. Funds rebalance. Dealers manage gamma. Producers and consumers roll hedges. Margin systems re-rate risk when volatility surges. And when those things happen together, the market behaves like a machine, not a debate. But that's not the part that matters most. The part that matters is how this machine can create both the squeeze and the trap, sometimes in the same week. Let's talk options, because silver doesn't just trade futures. It trades the hedging behavior around futures. When a lot of calls are owned and the market rises toward those strikes, dealers who sold those calls often hedge by buying futures as the delta increases. If the market is in a high gamma zone, that hedging can become reflexive. Price up forces hedging buy, which pushes price up, which forces more hedging buy. That's not conspiracy. That's how gamma works. The flip side is brutal. When price falls away from those strikes, hedges get unwound and selling accelerates. This is why you can see silver behave like it's possessed. Gaps, air pockets, sudden vertical candles, especially around key strikes and expiries. And that's why anyone promising you a smooth ride is either inexperienced or selling something. Silver is a levered, convex instrument in a thin, globally fragmented market. It is designed to humble certainty. So we're going to use that to your advantage. We're going to stop asking, what do I hope happens? And start asking, what are participants forced to do if X happens? Because that's where you get actionable edge. Here's a clean proof stack that doesn't rely on one fragile argument. First proof point, the curve. Watch whether nearby strength persists relative to later months. You don't need to be a curve nerd. You just need to notice if the front acts expensive and refuses to relax. Second proof point, deliverable categories. Watch whether the readily deliverable pool looks like it's shrinking or getting stressed while totals remain fine. If that category tightens during a delivery window, the market can react disproportionately. Third proof point, spreads and roll costs. If rolling a short position becomes costly, you're creating a pressure mechanism that can force covering. Fourth proof point, institutional flows, especially through vehicles that impact physical demand or hedging demand. You're not looking for a single day's flow, you're looking for persistence. Are inflows sustained? Are outflows getting absorbed? Does price action look like dip buying is systematic? Fifth proof point, on-the-ground symptoms, premiums, availability, delivery delays, retail inventory tightness. You don't have to pretend a coin shop is the global market, but retail friction is a canary. When the small end of the pipe gets tight, it often reflects stress upstream or, at minimum, rising demand for immediate possession. Sixth proof point, positioning. You don't need to worship any report, but you should respect that when positioning is lopsided, the unwind can be violent. And when a crowded short is forced to cover into illiquidity, price jumps become discontinuous. Seventh proof point, cross-market comparison. If gold is steady while silver is behaving like a lever, ask why. Sometimes it's industrial demand expectations. Sometimes it's positioning. Sometimes it's the curve. But the divergence itself is information. And here's the key. You don't need all seven to scream at once. You need a cluster. You need enough layers pointing the same way that the story becomes structural, not emotional. Because if it's structural, the $1,000 spikes keep happening in the plumbing even when spot pauses, and then spot catches up in a hurry. But the next detail is what flips the whole setup. The same structure that can launch silver can also be used to shake you out right before it launches. This is the volatility weapon. People love to say they don't want you to own silver. That's too cartoonish to be useful. The more realistic version is uglier. The market ES structure naturally rewards capital that can survive volatility and punishes capital that can T. If you're overlevered, if you're using short-term money, if you're emotionally fragile, volatility will separate you from your position without any mastermind needed. Margin hikes, widened spreads, liquidity gaps, these are just risk management responses to volatility. But they have an effect. They create forced selling at the worst moments. So here's your psychology shield, and I'm going to make it painfully practical. Silver will whip around violently even if the thesis is correct. That is not a warning, that is a feature of the asset. The difference between trend signal and noise is not whether the candle is red, it's whether the underlying pressure mechanisms are changing. If you see a brutal pullback but the curve stays firm, deliverable tightness persists, and dips get bought faster, that's noise inside a trend. If you see pullback plus curve relaxation plus easing roll costs plus inventories, loosening in the deliverable category plus ETF outflows that aren't T absorbed, that's a shift in pressure. That's a different tape. And if you don't define that in advance, you will make decisions at the exact moment your nervous system is least capable of thinking. That's where the real pressure starts. Now let's bring macro into it without turning this into a bedtime essay. Silver overreacts to regime shifts. When rate expectations wobble, when the dollar weakens or destabilizes, when geopolitics makes people question settlement safety, when inflation expectations jump, silver behaves like a levered expression of something is wrong. But it also behaves like a levered expression of growth and industrial demand are real. That's why it's so volatile. Two narratives can bid it for two different reasons, and then one narrative can suddenly disappear for a week and crush it. Right now, you're dealing with an environment where trust in institutions is fragile, where people are hypersensitive to policy signals, and where commodities can become a refuge and a battleground at the same time. That doesn't mean silver goes up in a straight line. It means the market is primed for discontinuous moves. And those discontinuous moves show up first in the curve, in the spreads, in the forced hedging flows. Everyone else sees it later and calls it unexpected. But this move isn't emotion, it's math. The calendar matters more than people admit. If we're in a period where month-end or quarter-end constraints are approaching, desks tighten risk. VAR models look uglier when volatility spikes. That triggers de-risking. At the same time, option expiry concentrates gamma exposure. Delivery windows concentrate physical settlement decisions. Rolling periods concentrate hedging activity. These aren't mystical dates. They are the weeks where a lot of independent actors are forced to touch the same doorknob at the same time. And when too many hands grab the same doorknob in a thin market, you get the lurch. That's why you can see a weekend gap, a thin liquidity overnight push, or a sudden no offers moment that reprices the whole curve. And that's why the mainstream misses it. Mainstream commentary focuses on the headline spot quote and a macro story, while the real action is in the mechanics of who has to do what by when. So let's make this extremely concrete for what comes next, because you asked for a warning, not a poem. In the next 1 to 2 weeks, the market is likely to present you with two scenarios, and you need to be mentally prepared for both so you don't get emotionally farmed. Scenario 1 is the controlled pullback and retest. In this path, silver cools off, pulls back into a prior breakout zone, think in round number clusters and recent consolidation areas, not a single magical tick, and then it stabilizes. You'll often see this look like sharp dip, fast bounce, then a choppy retest where sellers try to press, but each push down gets bought a little sooner. The confirmation signals here are not green candles. The confirmation signals are structure. Support holds in the mid-zone rather than collapsing. The curve doesn't fully relax, and the market doesn't offer metal cheaply up front. Scenario 2 is continuation squeeze and gap risk. In this path, silver doesn't give the clean retest people want. It grinds, then jumps, then gaps through round numbers because the combination of hedging demand, short covering, and front-end tightness creates a vacuum. This is where you get the scary upside. Fast moves that feel like they'll never stop, followed by equally fast snapbacks that punish late chasers. The confirmation signal here is speed plus stubbornness. Every dip is shallow, liquidity feels thin, and the market behaves like it's being pulled upward rather than pushed by enthusiasm. And here's the key warning. Both scenarios can be violent. A controlled pullback doesn't mean gentle. A squeeze doesn't mean safe. They're both the same machine expressing itself differently. But that's not the part that matters most. The part that matters is your checklist. Your if this, then that. So you can act like a risk manager instead of a gambler. Here's what to watch without getting lost in noise. First, watch the big, obvious psychological levels because other people watch them. Round numbers like $100 are magnets in silver, places where options cluster, where headlines get written, where positioning gets emotional. Price can stall there, slice through, or fake out, but the behavior around those levels tells you whether liquidity is real. Second, watch the most recent swing zone beneath current price. Call it the mid to high 80s region. If the market has been living in that neighborhood recently, because that S where trend either proves itself or fails. Third, watch the highs in the low to mid 90s area as a reference for whether the market is making higher highs cleanly or just spiking and reversing. I'm deliberately giving you ranges, not fake precision, because the market doesn't respect your favorite penny. It respects zones where positioning and liquidity live. Now overlay that with mechanics. If price pulls back into that support zone and holds while front-end spreads remain firm and roll costs on T collapse, that leans towards scenario 1, a retest that keeps the pressure alive. If price breaks below that zone decisively and the curve relaxes at the same time, that's the market telling you the immediacy bid is fading, at least temporarily. That doesn't kill the bigger story forever, but it changes the near-term setup. On the squeeze side, if price pushes back toward the highs and then through them and you see the market refusing to offer depth, thin books, fast prints, expect gaps and whip. And that's where the real pressure starts, because gaps don't give you the nice entries people fantasize about. They force you to respect risk first. Now about the $1,000 spike no one saw coming. Here's the reason I'm hammering this. The people who get hurt in silver are always wrong on direction. They're wrong on structure. They size as if the move will be linear, and then the contract math plus margin plus hedging flows turn a normal pullback into a forced liquidation. So the warning is not, don't own silver. The warning is, donne it. Own it in a way that allows the market its reflexivity to evict you. If your thesis depends on not getting a $1,000 punch per contract in a day, your thesis is fragile. If your plan expects you to endure a sequence of those punches without panicking, and you can articulate what would invalidate your view, then you're trading like an adult. And yes, this applies even if you're not in futures. The futures market is the tail that wags the dog. It's where hedging happens. It's where dealers manage exposure. It's where liquidity gaps become headlines later. When futures move violently, it bleeds into spot, into ETFs, into physical premiums. The next detail is what flips the whole setup. Physical and paper, done at T, have to diverge forever to matter. A temporary divergence is enough to create a repricing when paper can T ignore delivery and roll pressures. That's why spreads can lead. And that S, why watching only spot, is like watching a boxer smile while ignoring their footwork. Let's get even more tangible about the supply chain veto idea without overclaiming. Industrial demand has been a major pillar for silver because it's used in high conductivity applications and increasingly tied to sectors that done T-pause just because prices rise. Power infrastructure, electronics, solar-related applications, and broader electrification themes. When industrial procurement is active, it doesn't chase the last dime. It chases continuity. If procurement teams sense risk, logistics delays, refining bottlenecks, geopolitical disruptions, export controls, or simply a tightening market, they sometimes accelerate buying. That doesn't show up as a neat chart indicator. It shows up as stubborn front-end bids, as persistent tightness, as a market that refuses to get cheap even when macro headlines wobble. Meanwhile, supply is constrained by lead times and byproduct dynamics. Mines don't spin up overnight, refineries don't magically expand tomorrow, and recycling doesn't instantly flood the system. So a modest imbalance can create outsized price behavior when the market structure is levered. That's not conspiracy. That's the nature of a market where the marginal unit matters. And once you accept that, the whole right to $1,000 spike idea stops sounding like clickbait and starts sounding like a warning label on a machine. Small inputs can produce violent outputs, but the other side of credibility is counterpoints, so let's put them on the table. Silver can absolutely get dragged down by a risk-off shock. If equities puke, if the dollar spikes, if rates rip higher unexpectedly, silver can get sold alongside everything else, especially because it's liquid and volatile. Also, if the front-end tightness is more about temporary logistics or a one-off positioning squeeze, it can fade quickly once the calendar passes. And if ETF flows reverse hard and dealers unwind hedges into a softer tape, you can get a fast downdraft. So the thesis is not up only. The thesis is structure is primed for discontinuity. And the action plan is watch the pressure gauges, not the headlines. Because if those pressure gauges stay elevated, dips are more likely to be traps for shorts than traps for longs. If those gauges ease, you shift to defense and wait for the next setup rather than marrying a story. And that's the psychology shield again. Detached from the need to be right, attached to the need to be positioned correctly for the volatility you're actually in. Now, let's talk about the institutional behavior that people whisper about without making it legally silly. Institutions aren't a monolith plotting in a room. They're desks with constraints. They're producers hedging revenue. They're manufacturers hedging input costs. They're dealers hedging options books. They're funds managing risk into month end. Their actions can look coordinated because they're responding to the same incentives at the same time. When volatility rises, risk limits tighten. When gamma is concentrated, hedging flows amplify moves. When deliverable tightness appears, shorts become cautious. When roll costs rise, carrying a position becomes expensive. When margin requirements increase, weak hands get forced out. None of this requires a puppet master. It requires a market structure that channels behavior. And if you learn to read those channels, you stop being surprised. You start being prepared. And that's where the real pressure starts, because preparation is the only edge most people can actually own. So here's your near-term roadmap compressed into a form you can actually use. Watch the curve behavior. Is the nearby staying bid relative to later months, or is it relaxing as price cools? Watch deliverable category stress. Is the readily deliverable pool tightening in a way that matters, or is availability improving? Watch how price behaves around the recent support zone. Does the market respect it and snap back, or does it slice through and spend time below it? Watch how price behaves into the highs and round numbers. Does it stall with heavy selling, or does it grind and then jump as if offers are thin? Watch the quality of pullbacks. Do they feel like panic flushes that get absorbed, or do they feel like steady distribution where bounces are weak? And watch volatility itself. If volatility spikes while the curve stays firm, that's often pressure building. If volatility spikes and everything loosens, that can be a sign the stress is releasing. Then apply the two-scenario lens. Scenario 1, controlled pullback and retest. You're looking for stabilization, faster dip buying, and no collapse in the underlying pressure gauges. Scenario 2, continuation squeeze and gap risk. You're looking for shallow dips, acceleration through key zones, and the market behaving like it's being pulled upward by forced behavior. In both scenarios, decide in advance what invalidates your thesis. For a bullish structural view, invalidation is not a red day. It is a breakdown that changes the pressure story. A decisive failure below the recent support zone with accompanying easing in the curve and a tape that stops absorbing supply. If that happens, you don't argue with it. You adapt. The market doesn't pay you for loyalty. It pays you for correct exposure. And it's not the part that matters most. It is the part that keeps you in the game long enough to catch the real move. One more thing before we land this. The most common way people lose in silver is not by missing the rally. It's by getting chopped to pieces on the way to being right, then rage trading back in at the worst moment. That's the emotional manipulation the tape will attempt on you, and it's not personal. Silver is a volatility engine. Headlines will alternate between silver is unstoppable and silver is collapsing within days, sometimes hours, because volatility sells. Your job is to trade the difference between noise and signal. Signal is structural pressure, curve behavior, deliverable stress, persistent absorption of selling, reflexive hedging zones. Noise is the day-to-day macro narrative roulette. If you can keep that distinction clear, you stop letting the market use your emotions as liquidity. And if you can't, the market will gladly take your money and call it lesson. So yes, consider this your major warning. The $1,000 spikes are already happening, and they'll keep happening, because the leverage is embedded and the calendar concentrates stress. The question is whether you'll recognize them as pressure building or misread them as random chaos. If you want a clean way to frame it, here it is. Silver is not just a bet on price. It's a bet on the friction between paper promises and physical immediacy, mediated through spreads and forced hedging. When that friction rises, the tape gets violent. When that friction falls, the tape can sag. Your edge is watching the friction, not arguing about the story. And if you're the kind of investor who cares about mechanics, who wants to understand what is actually forcing the market, hand instead of just collecting slogans, stick close to that identity. Don't chase the loudest take. Build a process. Compare notes with people who respect risk and structure. And when the next unseen $1,000 punch hits the system and everyone acts shocked, you'll already know what it means, what it forces, and what to watch next. Because you weren't looking at the lie, you were listening to the spread.